kind of give you a love letter from the attorney. So we may have some forward-looking statements tonight. So if you hear words like may, will, should, expect, plan, seek, anticipate, these are all based on our best understanding of the market, information that we've received from different sponsors and our research that we've done. But you will, of course, want to work with your financial professionals, CPA and attorney, to develop your own point of view around where the market is going.
Lon was saying, most important thing here, everything we're going to be talking about is for your educational purposes only. This is not specific investment advice, and we are not offering any investment opportunities.
Mostly tonight, we're going to be talking about how to unlock your equity. If we have a little time, we'll talk a little bit about some of our investments. So at the Ironton Capital Investment Committee, here's your 3 members. We've all got, at least a decade or 2 of experience in investing, and you can see a little bit on our track records there. So what I want to do, though, is turn this over to Joe and tell us a little bit about the analysis that you do for your clients when they've got, let's say, a rental property they bought maybe in 2012. It's appreciated a lot. The rents have gone up, but not nearly as fast. So while the cash flow is growing, maybe the cash flow isn't growing tremendously. And they're probably in a situation where, they've got a relatively small loan relative to the value of the property at an incredible interest rate. What are some of the options that they might want to explore?
Yeah, absolutely. So really there's 3 options, right? You can do nothing. I guess maybe 4 options. Do nothing, keep moving forward with the property. You can do a cash out refinance and find some other ways to invest that, whether that's buying another rental property, whether that is investing in one of the Ironton funds, whether that is investing in the stock market. The number 3 option would be to take out a home equity line of credit. And I'm really happy that we have Stacy here. She's got some great options for that. And then the 4th option would be sell the property and invest that money into Ironton or another area that you want to invest into. And let's see, Gail said, I am going in and out. Apparently I'm having bad internet too. But hopefully you guys can hear me okay. And this recording will be available later. So if this is not clear, we will resend this recording to everybody that's here in attendance. So those are the 4 options that you have. Do nothing, which is often a good option. Take cash out and reinvest that cash somewhere else. Take out a home equity line of credit and reinvest that cash, or sell the property and reinvest that cash. So what we've put together here is an analysis, and we're going to start on the left-hand side. And everything in yellow are the variables for your property. So let's say we have a current value of $475,000 at an annual appreciation of roughly 5%. Now, properties in the past have gone up 10%, 12%, 15%. Maybe this past year they were up 2 or 3%. Whatever you think that average appreciation is over the next 10 years, let's say 5%. And your current loan balance is $225,000. That gives you up there at the top, it's not in yellow, but your current equity is $250,000. And your monthly payment, just your principal and interest, is $1,432. So you've got a really good low interest rate on this loan. And your annual net operating income is $23,175. Now, your net operating income is excluding the mortgage. So assuming you had that property paid off, what is your net operating income? After making the mortgage payment, your current monthly cash flow is that $499 a month. And Lon, I believe this is a property that you own that we've plugged in for this analysis. Is that right?
Yeah, this is one of them. I think I sold this one last year.
Yeah, so this is a real property, which is an important point that we always like to have. What's a real transaction that we can compare here? Now, let's assume your marginal tax rate is 32%. So that covers everything in that top left-hand quadrant. Now, let's move over to the right and look at what happens over the next 5 years if you don't do anything, because that's a reasonable choice. In 5 years, you would expect that value would have increased to a little over $600,000. And you would have paid down the loan, assuming you have principal and interest payments, to $210,000. Now, your cash flow is that next line down. You would have made just under $30,000 in cash flow, and you would have gained the appreciation. You would have also paid down the principal, and you would have gotten some tax benefits through depreciation. So totaling up those 3 numbers gives you $167,000 plus that $30,000 of cash flow you've received benefit of $197,000 for doing nothing and just owning that property for another 5 years. So that projected return on investment in 5 years is over on the right-hand side in orange, 15.8%. Now, of course, there's taxes on some of these items. So your after-tax projection based on your marginal tax rate is you would have made a little more than 10%. I guess a lot more, 10.74, so a little less than 11%. So Lon, let me pause there. Did I explain that well? Does that make sense?
Yeah, it makes a ton of sense to me. I think you did a great job, but if anybody's not clear on it, definitely drop a question into the chat box below. And we're taping all this, so you can always watch the recording again. But if any of you guys are in this situation, what I'd really recommend you do is reach out to Joe and have him build this spreadsheet for you and then do a webinar just to go through your property just with you. I think that's really where the insights come in.
Absolutely. So now let's move to the next quadrant down on the left-hand side. So cash out to 75%. So you can take cash out of an investment property up to 75%. So your new loan amount would be that first line there, $356,000. Let's assume you have closing costs, because generally you do when you take cash out of a property. And the new interest rate on an investment property loan would be right at 7.875. So that increases your principal and interest to $2,056. And now what you see is you've got negative cash flow of $124 a month. So you were making $500 a month. Now you're losing $124 a month. But let's say of those funds, you don't take the full 75%. You take $50,000, which is that next line that's highlighted there in yellow. So you take $50,000 out. What happens over on the right-hand side? In 5 years, that loan balance has paid down. The value goes up still to the same 606. So your property appreciates independent of the loan that you have on it. So the loan on the property does not change that appreciation, also does not change your depreciation. But now your cash flow is negative. So you only have negative $7,462 of cash flow, plus that net gain from appreciation, principal reduction, and depreciation of $167,000. Going down to the next line, let's say you invested that $50,000 into the Ironton medium-term fund. Over the next 5 years, that would return you roughly $38,000. So continuing over to the right-hand side, you see that you would have returned $198,000. Continuing further over, highlighted in blue, the medium-term fund has returned you 10.79%. Well, what if you invested that $50,000 into the Ironton long-term fund? You would get return of $64,000. Adding that onto the return of the property, $224,000, or a 12.2% after-tax return. So if you go down to the graph below, you'll see on the left-hand side that 18% is your pre-tax return if you were to take out $50,000 and invest it into that Ironton long-term fund. That's the line in green. And then there's no blue line because it's actually covered up by the orange line. And what you see, if you were taking that $50,000 out and investing it into the medium-term fund, it's kind of a wash, right? So this shows you doing nothing or putting it into the medium-term fund isn't really going to change your return in percentage basis or your return in dollar basis. So over on the right-hand side, that's your after-tax return. And again, the green, you're going to be returning 12.2% after tax. The orange and the blue is covered up by the orange because it's basically the same. So Lon, in this scenario, I don't think it would make a ton of sense to take $50,000 out and invest it into the medium-term fund because that's pretty much a wash, but it might make sense to take some cash out and invest it into the long-term fund if you're looking to maximize your return over a 5-year period. Would you agree or disagree with that, Lon?
Yeah, I think that's the general line of thought. And what we've seen some people do is sometimes they'll take a small amount of their proceeds, put it in the medium-term fund, and then the cash that comes out of that, they'll use that to supplement the payment that they've got to make because the payment's now going to be higher on the mortgage. And then everything that's left over, they invest for the long haul. And that tends to give like really good results for a lot of people.
That's exactly right. So what you might do is instead of taking $50,000 out, maybe you take out 62,000, and all you'd have to do is put $12,000 into the medium term fund. And Lon, that pays out on a quarterly basis, right?
Yep.
So if I put $12,000 into that medium term fund, that would pay out $480 once a quarter, which covers that $120 negative cash flow. And then I would have $50,000 net to invest into the long-term fund. And this investment, it's a dual investment now, is cash flow neutral, would not cost me any money from my negative cash flow. And I think that's everything on this slide. I see that we did get the audio fixed. And can we get a copy of this? Yes, we'll send this presentation out. Lon, anything to add on this one?
No, I think that's a really good sort of setting the baseline of it.
Okay, so let's go to our next slide and let's talk about, thank you. Let's talk about what happens if instead of doing a cash out refinance, we do a home equity line of credit. So the top section is exactly the same. So 5-year projection, doing nothing, nothing's changed. But now this is where we're going to bring Stacy in. So Stacy, if we wanted to take out a home equity line of credit, we can generally borrow up to about 70%. Does that sound about right?
Oops, you might be on mute, Stacy.
So,
There you go.
Now we got you.
there we go. It's working now?
Yes.
Okay, perfect. Thank you. Yeah, typically 70% is a good rule of thumb if you're looking at it from an investor property perspective. Some cases, if you wanted to borrow on a home equity line of credit in your own name, you can go up a little bit higher, typically 7. Go a bit higher, but I would say that's really case by case. But 70 to 75% is typically your guideline for cash out. Do you want me to jump a little bit more into that as far as structure, Joe, or hold
Please.
off?
Yeah.
Okay.
Please.
Two ways you can look at it. One, if you're willing to borrow in your own name and take out a home equity property by property, a home equity line of credit is going to be your most streamlined option. Lowest cost and fees. Typically, you will also get away with no prepays if you go with a credit union. Banks will traditionally have about a 3-year prepayment or early cancellation fee if you actually close out that line of credit before then. But your barrier to entry is going to be fairly low for cost. Typically, it's the cost of an appraisal if need be, potentially title, and that's about it. For those who have a few more properties in their portfolio and want to look at maximizing their cash out, or maybe borrowing potentially in your business name, you have the option of doing a business home equity line of credit where you can consolidate a few properties into one line or one cash out term loan and have one deed or one lien across multiple properties. So still that 70-75% cash out does apply. The difference though, you will pay maybe just a little bit more in an origination fee. You're not going to pay annual fees, which is a nice benefit. You can do a line of credit to allow some flexibility with interest only payments, or you can have a fixed rate amortizing term loan to help amortize and pay down some of that debt. In the business home equity structure, you can borrow in your business name. What that will do for you is it will pull the loans off of your personal credit bureau. So typically when Joe is originating loans, they're looking for a certain number of mortgages or a maximum number of mortgages an individual can have on their bureau. This will help keep those number of mortgages lower and not reflect personally and report only to the business side as well. Still similar tax deductions, add it to your Schedule E if you like, taxable interest or deducting the interest on your taxes in that space as well. I would say just on the business side of it though, you have more flexibility with modifications. So as your property structure may change, you may need to drop a property, replace it with another. You have more flexibility to modify instead of having to do a full refi if you do go the business route from a HELOC perspective.
Mm-hmm.
Nice.
Another great thing that I want to add, Stacy, is if I do a HELOC with you, I maintain that preferred financing that I got maybe 5 years ago that's at a 3% or 4% on my first. I'm only paying that higher interest rate on the HELOC. Is that correct?
That's correct. So your blended rate could essentially be much lower or closer to what you would pay in an even lower rate environment right now. So even if you're taking out a HELOC right now and you're at 7.5% or so, you're still in a much better position with that blended rate because your cost of funds could potentially be in that high 4s to low 5 range when you take into account the rate on your first mortgage.
That's
And
exactly right.
I see a question in the chat. That covers 1 to 4 unit properties. There is an option for multifamily. So if you happen to own something that's 5 units or more, business lines of credit are an option. No HELOCs when you get to those 5 units or more, but you can use as many 1 to 4 family residences in one portfolio as you like. So if you happen to have 7 or 8 condos, townhomes, single families, you can pool that into one collateral pool secured by one line of credit. And then I notice a couple of questions popping up here. Do you have to personally guarantee the business loan? Traditionally, yes. Most non-recourse loans are done in a first lien position and typically at about 60% or less in exposure or LTV. And I noticed one on short-term rentals. Depends about lender to lender if they'll use that income for eligibility purposes, but short-term rentals are fine in our space. We take a look at that and we just consider what do vacancies look like, cost of property management overhead. There's usually a little bit more maintenance in that space, but both stabilized short-term rentals and then more newly acquired properties are considered as well.
Excellent. So on our slide here, if we were to take out that new home equity line of credit with Stacy, there are some costs. I just estimated 2%, which I think is about right. It's a smaller amount for title, smaller amount for appraisal. And so what you would see on the left-hand side, your monthly cash flow goes down from $500 a month to, in this example, $223 a month, taking that same $50,000 out. Now, with that $50,000, you could invest that into the medium-term fund, gaining $38,000 over the next 5 years, or into the long-term fund, gaining $64,000 a year, $64,000 total over the next 5 years. Thus, over on the far right, giving you an after-tax return for the medium-term fund at 11.9, or an after-tax return with that $50,000 into the long-term fund of 13.3. Now, you might be wondering, hey, but I thought the long-term fund pays 12%, the medium-term fund pays 12% and the long-term fund pays 18%. It absolutely does, but you have to factor in what's the return you're getting on the property and then balance that with what's the return you're getting in the medium or the long-term fund. So it's always going to be a little bit lower if you keep the property, if that property is returning a lower percentage versus what the medium or the long-term fund might return. And then that's also represented down there on the bottom 2 charts. The left-hand side is your pre-tax return at that 19.6, 17.5, or that same 10.7 if you do nothing, the orange line. And then after tax on the right-hand side, 13.3, just under 12 at 11.92, or 10.7 if you were to do nothing and just maintain the property. So let's pause for a minute here. Any questions? Let's see. Do you loan across the United States or only in your state? I lend in Colorado, New Mexico, Wyoming, and Nebraska. Stacy, how about you? What areas do you cover?
We do similar states as well. Figure Colorado, Wyoming, and put a big circle around it. All the surrounding states that extend into the Montana, Nevada space, Utah, down to Arizona and New Mexico, Nebraska, Kansas. And I would say case by case in other states. It depends on that borrower relationship. We like to have some type of link to Colorado or Wyoming.
Very nice. Lon, anything to add on this slide? You've done some HELOCs to invest into other things in the past, right?
I have done a couple, and I'm actually working on one with Stacy right now. So it's actually been a smoother process than I would have thought it would have been. So I've been really enjoying that so far. So just as a quick recap on this slide, Joe, it sounds like by someone taking a HELOC and investing it at a higher rate of return, how much extra cash would they have by the end of 5 years?
So that is going to be kind of in the middle. I know you guys can't see my mouse pointer, but you'd have an extra $38,000 in the medium-term fund or an extra $64,000 in if you invested that into the long-term fund. So that is true growth of your capital over and above what you would receive by doing nothing. So kind of a simple way to think about it. Hey, I do nothing, or I could make an extra 38,000 or an extra 64,000. Those are big numbers in my world.
Oh, they're absolutely huge. And, the process for me to apply for the HELOC with Stacy probably took me an hour and a half just to gather up tax returns and things. And the process to sign up with us is less than an hour. So, I mean, for under 3 hours worth of work, you can make an extra $30,000 to $60,000 of return per investment property. It's a pretty good dollar per hour.
That seems decent. Yeah.
So, Stacy, there's a couple more questions there for you.
Yeah. So I see one on here as far as combining a HELOC with an investment property and a primary home. Yes, that can be done in certain cases if we can document that it's for business use. And that's permissible, or to show future investment, like something along the lines of what Ironton Capital offers. Sorry. The key thing when applying for just your standard consumer HELOC, if it is designated for business purpose, that actually is a big no-no. So you do want to state that it's to acquire more real estate. You don't really want to allude to the actual term business in that space. But yes, a mix of properties, investment, primary, second homes are even an option in this space as well. Primary homes actually have a little bit more flexibility in that world as far as cash out. You can look at up to about 90% in cash out on a primary residence, and sometimes second homes are given more flexibility as well.
Outstanding. Well, Lon, let's go ahead and go to the next slide and talk about what if we were to decide to sell the property.
Yep.
So I'm going to lean on you a little bit on this one, Lon. Let's say we've got the same information there at the top left, but now we've got some new information here of the original purchase price of $275,000, and it was purchased several years ago in June of 22. And then we look at how much depreciation have you utilized. If you were to sell the home, you're likely to have to pay real estate commissions. And I know this is, something that's very much up in the air right now, but if you were to sell it, what would that do to the amount that you'd have to pay in real estate fees, and then other fees, which generally you're going to have your final title commitment, the final water bill, just some stuff, some transaction cost. And then how much would you pay in capital gains? Your net proceeds would be $186,000 after paying that capital gains of approximately $30,000. And the next step here, what if you wanted to invest this money and take all of it and invest it into Ironton? So if you took $186,000 and invested that into Ironton, over the next 5 years in the medium-term fund, that would return you $142,000. Or if you invested it into the long-term fund, that would return you $240,000. And we do have a typo on here. This is my error. Your projected return over on the right-hand side for the medium-term fund would be a flat 12%. The projected return for the long-term fund would be a flat 18%. And then your after-tax return in that medium-term fund would be 7.75, or in the long-term fund would be roughly 13%. Now, also, there's a little formatting error down here. With the green bar, you would have a higher return, but maybe not as much cash on the left-hand side, because it does take some time because you're starting from a lower dollar amount. Because there's the cost of selling the home, you're starting with a lower amount. You're going to return more percentage-wise, but it takes about 5 years until you're crossing over and returning more dollar amount. Would you agree with that, Lon?
Yeah, that sounds about right. It does take a couple years.
Yep. So while you're getting a better return, you do have to understand there's some cost associated with selling the property. So if you've got a property that's performing really well and you're happy with it and it's never a hassle, maybe you don't want to sell it. But maybe you have a property that, to borrow one of your phrases, Lon, the property's haunted, right? It's always a nightmare. It's impossible to keep the tenants in there. There's constant maintenance issues. It's just a hassle. This is where, with that particular property in your portfolio, you might think about selling it, because while I'm going to start over after some cat taxes and selling costs, it might be good to just get rid of that headache. Would you agree with that, Lon?
Well, the majority of investors I talk to, if they've got 5 or more properties, they've all got one like that, sometimes 2 or 3. It's just inevitable that some work better than others for sure.
That's exactly right. What do you want to add on this this slide, Lon? What do you think?
Oh, that's the key thing right here. So if you're enjoying the property, then keep it, get a HELOC to tap the value of the equity and pick up an extra 60 or so $1,000 over the next 5 years. In this example, if it's a property you're not enjoying, sell it, and then you can make a little bit more yet. And I've got an analysis I can help you run on this. If any of you guys are curious about that, I'd be delighted to do that for you. I do it several times a week.
Yeah. Stacy, what do you think? Anything to add on this one?
I would say no. I think the slide is pretty extensive as far as the potential return in that space. I would say, though, I do see a comment in there about needing tax returns to apply for a HELOC. Traditionally, yes, 2 to 3 years, depending on the type of product that you are applying for. And then also we like to see at least a rent roll if you own multiple properties. We want to see a schedule of the real estate that you own. And then also, since we're this far into 2024, your year-to-date profit and loss and balance sheet for the properties too. So it's always good to work with a property owner who can track their income and manage any upturns or down cycles they might see with their properties as well.
Yeah, exactly. All right. I think we've covered a lot of the questions. Let's see, Lon, what's our next slide? I don't have this presentation memorized.
All
Oh,
this stuff.
yeah. So you want to touch on that, some of the occupancy challenges?
Yeah, before I make that transition, just from a lending standpoint, Stacy and Joe, is there anything else you guys wanted to cover?
Stacy, go ahead.
I would encourage people. I spent about 20 years on the banking side and came to the credit union space now. And over the last few years, I would encourage people to always ask for some type of creativity. Ask for the flexibility, an extra 5% if you'd like to maximize that for cash out or other considerations. I would also think that you should think about loan structuring. Structure your loans at $400,000 and less for each cluster of properties or each loan that you're taking cash out. Reason behind that is you can use automated or desktop type of values instead of full appraisals. That'll keep your costs lower if you don't need to actually go to that extent for it. But look for a lender that's creative, who knows their policy very well, knows where they can flex and have some nuances, and also kind of eyeball it ahead of time, or do your cocktail napkin and pen math just to pencil it ahead of time. So you get to a quick response or a quick structure of how you can move forward.
Yeah, I completely agree. Yeah, and as far as anything I would add, I completely agree with Stacy. You know, make sure you're being open with your lender about what you need, what you're trying to accomplish. That's one of the first questions that I ask all of my clients. What are your goals? What are you looking to accomplish here? Because there's a lot that goes into lending and making sure that we can get you fully approved. So the more information you can share with your lender, the higher the likelihood for your chances of success.
That's great. And Stacey, we've got a couple more questions for you in the chat box.
All right. So if you don't have a tax return for the property that you just purchased, that's okay. If you are purchasing a property that has historically been an investor property, always try and get the seller's financials. They don't have to release their full tax return, but if they can at least get their Schedule E or the business tax return they might have tracked that property on, that's always helpful. That can give us a chance to look at historicals. The other thing we'll use as a guide is we'll look at your projections. We call that kind of pro forma. So projected income and expenses on the property. An appraisal will also tell us what expected income and expenses are for the property. So if you're in a rental and you think you're going to rent it for about $1,400 a month and only have $100 a month in expenses, that appraisal will come back and give us an idea if that's realistic for the market, both for income and expense. So it's okay if you don't have something for when you recently acquired, and then how many properties you can get if it's a HELOC. Typically, lenders will limit you somewhere between 2 and 4, and usually a maximum exposure. So in our case, we'll allow up to 4 investment property HELOCs in your normal world, your consumer world, up to 750 in exposure. When we want to go larger, we swap it to the business side and have a little bit more of a strategic structure, less of a draw period. So you're not going to see your 15, 20-year draw period like your standard home equity, but also really customize loan structures that will help support what the portfolio needs. I see a question here. Does it apply for also outside of Colorado properties? Typically a blanket approach across the board. Sometimes lenders, if they're making an exception or going into a state they're not as familiar with, they will limit loan to value just a little bit. But typically we approve in the markets we know and have lent in before. So did I miss any in that, Joe or Lon?
No, you got them all.
Okay. Perfect. Great questions. Love the engagement. So thank you guys.
Oh, there's one last one here about what's the HELOC business loan look like for someone who owns more than 5 properties with no mortgage? You probably wouldn't need to get a HELOC if there's no mortgage. They could probably just take out a primary, and then that might be even easier yet.
It could be. I would actually really partner closely with Joe in this case. At that point, we really want to combine our forces together and analyze what that best rate picture is for you. With mortgage rates coming down a bit, it's looking like maybe an additional rate cut or 2 next year. We want to make sure we maximize that long-term rate exposure for your investment. But yes, a HELOC is still a solution on properties, people with more than 5 properties, but I'd want to check with Joe first to make sure we optimize that potential lowest rate possible.
I agree.
Fabulous. Wow, what a great discussion here. This is great.
Yeah.
All right. So if you guys think of other lending questions, definitely jot them into the chat box. Otherwise, I'm going to shift gears on our topic of unlocking equity. So I've talked on a couple of prior webinars, and a lot of you guys have been on many of these, where I talk about long-term rentals and how, the value of the property has gone up, the rents have gone up slower, and a lot of times it makes sense to sell them. So what I want to talk about really on this is something different on short-term rentals. I've got a number of those. So if you guys aren't aware, the number of short-term rentals on the supply side has skyrocketed in the last couple of years. And the reason for that is there's a lot of people with very low mortgage rates. They may live in Denver. They get transferred to Austin. They're financially strong. They can afford to buy another house in Texas and not have to sell the place in Colorado. And since it's got a cheap mortgage, they're saying, I'm going to keep this place in Colorado. So some percentage of those guys will put into the long-term rental pool, and some people will put in the short-term rental pool. And as a result, the number of short-term rentals has skyrocketed. So demand has continued on a small, healthy increase of more demand for short-term rentals, but the supply has gone up a lot. So as a result, occupancy is down, rates per night are down, and revenue is down a lot. So I'll give you an example here. If you take a look on the left-hand side, I'll show you the Bijou property. That's on Bijou Street in Colorado Springs. This is a duplex. We're going to talk about that in detail. My occupancy has gone from 93% to 55%. So that's my worst example, but you can imagine that has made a pretty big change in my economics. So that's the worst. The middle example is on Dayton Street, kind of halfway between Denver and Aurora. We've gone from 87% to 62%. And I've had a couple that have only gone down by, a couple percentage points, but everybody's down, nobody's up. So if you take a look at some of these other ones here, you can see that, just in the space of a year, there's been double-digit declines. So let's just take a look at a specific. My other challenge is I've got 5-year loan from a commercial bank with 5-year arms that are all expiring on the rate locks in 25 or 26. So, some of these guys I'm at 3.75% now, but I won't be for very much longer. So if you look at Bijou, this is extremely close to downtown Colorado Springs. This is a gingerbread Victorian that's been fully remodeled. It's a gorgeous place. It's an easy walk to downtown. I bought it for $300,000. It's probably worth $500,000 now. And it's grandfathered in for a short-term rental license. So I'm at 3.5% roughly on this. So lifetime to date, if I sold it at the end of this year, I'd probably be at about a 27% internal rate of return, which is really fantastic. But if I hold this for another 5 years, my next 5 years, my rate of return is going to be more like 9% per year. So that's partially because the rate of appreciation is going to slow down. My revenue growth is a lot smaller than it used to be. And my mortgage will probably reset to at least 6, if not 6.5. So looking at this, if you take a look at the upper left, this is what's happened to me from revenue. I've gone from almost 100 grand to under 60. So I'm assuming that the declines aren't going to get any worse, but it's just going to very slowly dig out. My expenses, and everybody on this call who has a rental property, I'm sure your insurance has doubled. I'm sure your taxes are up, and you probably aren't getting any breaks on anything else either. The next one over on the top is cash flow after mortgage. Was really strong. It's about at break even. Now it's going to be negative after the rate reset. So if you look at the lower right, my return on equity, instead of being 100% a year, is going to be more like 3 or 4% a year. So if you've got short-term rentals, you're going to want to try to do an analysis and a projection, sort of like what I've done here. And the inevitable conclusion with me with Bijou is that I have to sell this next year. My only question now is, do I sell it in the spring, which is traditionally the best time of the year to sell? Usually the summer is the best time of the year for Airbnb rental. So maybe I take the busy summer season and sell right after that. That's something I've got to decide. But all of you guys should probably be looking at that if you've got a short-term rental. If you've got any questions on that, feel free to jot that on there as we go through. I'll show you just one more here. So this is a single family in Centennial. I think this is a 4-bedroom, 3-bath. It's a fully renovated mid-century modern. Short-term rental licenses, at least at the moment, are easy to get in Centennial. And once again, I've got a great rate on this lock till about 26. So if I sold this next summer, from when I bought it to next summer, my rate of return would be about a 20% per year, which is pretty great. But looking forward after that rate reset, I'm probably going to be more along the lines of about 10% per year for my IRR, for all the same reasons as what we just talked about. So this is another one I'm probably going to have to sell, because it just doesn't make sense for me to keep it and deal with it's some amount of work, even with a property manager, versus I could just invest it passively and just not even have to bother with it anymore. So that was the main thing I wanted to sort of relay to you guys, is that some of your short-term rentals that were really kicking ass 2 or 3 years ago may not still be in it. You really owe it to yourself to do this analysis to see where you're at with your property. So with that, I'll open it up to questions. Jot down questions in the chat box. And meanwhile, Stacy, I think I've got one more form for you. If you've got a commercial property, can you get a HELOC if there's no mortgage in place on the property? Oop, yeah, Stacy, you might be on mute.
Oh, might have a delay in my.
There you go. There you go.
When I take myself off, I apologize. Yes, the answer is yes. There are certain lenders that will allow lines of credit on a property, both in first and second lien positions. We happen to be one of those as well. If you wanted to pull funds out, typically you can get away with an evaluation for loan amounts up to $1 million. An evaluation will typically cost you about $1,200 to $1,500 from an appraisal standpoint. If we do need to go higher, or a full appraisal is needed, if it's a more complex property, you're looking at appraisals probably in about the $3,000 to $4,000 range right now. But investment commercial properties are permissible, as well as owner-occupied commercial properties in that space too. Even mixed use. So if you happen to have something that might be retail on the bottom or industrial on the bottom and residential space on top, those are flex spaces that are permissible in some lenders' credit policies, specifically ours.
Perfect. This has been awesome having you on this call, just being able to fill in all this color and how the system works.
I think these are some fantastic questions, and I'm just excited because I think that this whole concept and model really pushes you to think outside the normal investment property boundaries, and how can you maximize your time not having to manage a property, the tenants, the spaces, and all that. How can you actually invest well and smart while still having that passion for real estate? So kudos to you guys.
Right. Thank you. Good team all the way around.
Absolutely.
Let's see. Does anybody ever lend on out of the country properties like Belize or Guatemala? Boy, that's a tough one, Nick. I'm sorry. Some of
No.
these countries, they tend to be like all cash or just very high down payments.
Yep.
Yep.
Or
Sorry,
legal
no.
structures. All right. Well, that's all I had on my side. Do you guys want to talk about anything else from a lending standpoint or any trends that you're seeing?
No, I really appreciate all the questions. This has been a great conversation, Lon. As always, appreciate you putting this together for us.
Yeah, delighted to be able to do it. Two other questions just came in. So, what's the requirement for a commercial property HELOC? I assume Stacy, like a slightly lower amount of leverage.
Yeah, typically 70% on a commercial property HELOC. We will look more closely at how that property can support the debt and then you as the borrower too. So those of you who are used to a debt to income ratio and how to measure that, right? Your personal household expenses versus your household income. We want you to be at about a 50% or lower personal household debt or personal DTI, about 50% or lower. And then on the property is going to need to generate a little bit more cash flow than than the amount of debt you have on the property. And what I mean by that is for every dollar in debt payment you have on that commercial property, you need to have $1.20 in net income. So if you have $10,000 in outgoing payments annually on that commercial property, we want to make sure when we add a HELOC behind it, you have at least $12,000 in net income to be able to support that debt. So we will look a little bit closer at that debt service coverage ratio. It's similar to DTI in that consumer and residential lending world. And then I know when Will has a question about Texas, referrals for that state, Joe and Lon are so well networked across the U.S. So likely between some team member on here, if it's something in a state we didn't mention, likely there's a contact there or some type of introduction that can be formed in that space. So
I have some great folks that I work with that cover Texas for us. So please reach out to me directly. I'll be happy to chat and help you with that.
Perfect.
And while we're wrapping up, I'm going to go ahead and put in my contact information again. Stacy, if you want to do the same. And let's see, I did see a question here. I have a home that I rent long-term and don't have a loan on it. What are my options for getting a loan against it? Tons, reach out to myself. We'd be happy to help you, with an individual cash out loan. Or if you want to have a line of credit in first position, reach out to Stacy. I think that's something that either one of us would be able to help with and get you probably a very significant amount of cash out in order to invest into buying more properties or invest passively with Ironton. Lots of different choices on that. So we can absolutely help with that.
Perfect.
I do see a question on there, if you don't mind, Joe and Lon. There is one asking about if you don't have a home or investment property and still want to invest, how can that occur? Which is perfectly fine. I'm sure there are some minimums where it makes sense, but I see that it's just mentioned that potentially they're currently invested in stocks or other types of brokerage products. Use an advisor, chat with your advisor. We have a team that works for us at Blue. I'm sure Lon and Joe have trusted advisors in their space too, but you definitely want to work with an advisor and a CPA to look at the tax strategy of extracting some of those investment funds out and how you would redirect them while minimizing that tax implication to you. So I would just make sure you have your team ready to support you in that space, but it can easily be done in the right world.
Mm-hmm.
Good answer to all that. Our target with the short-term income is around, actually I've got a slide for this, might make it a little bit easier. Let's just go ahead and do that. The short-term target is between 8 and 9% per year, so it's about 2% per quarter. The medium-term income is 11 to 13%, so about 3% per quarter. And then our long-term growth fund, our target's in the 17 to 20% annual return range. So nothing like the 6,000% return that you got in the stock market. So congratulations, whatever stock you picked, you won the jackpot. But if you get a 17% return and you just let it keep compounding for 5 years, you'll essentially double your money, and you can do really well just doing that.
Yep.
All right. Well, thank you, Stacy. Thank you, Joe, for being on tonight. Thank you. We had a really great turnout tonight on the crowd.
Yeah.
Thanks to all of you guys for being here so late in the day, and I look forward to working with you all soon, and have a fantastic evening.
Thanks, guys. We'll see y'all soon.
Thank you.
Thank you.